Question number 186, it says a business is considering closing one of its branches which has the following budgeted performance for the year. We have the revenue, variable cost, fixed cost, budgeted profit or loss is there's a loss of 150. Variable costs include 50,000 for labor cost. These staff would have to be made redundant at a total cost of 20,000. Fixed costs contain a fixed rent charge that is specific to the branch of 60,000 as well as 40,000 of centrally allocated costs. All other fixed costs will be saved if the branch is closed down. What will be the net benefit for the year of shutting down? So they're planning to shut down. Why? Because there is a loss of 150. If there is a loss of 150,000, in that case, is it advisable that they shut down that? So the decision is about shutting down or continuing with that. This is the income statement. After that, we can also see that variable costs include 50,000 for labor cost. These staff would have to be made redundant at a total cost of 20,000. So to remove them, some additional cost of 20,000 has to be incurred. Fixed costs contain a fixed rent charge that is specific to the branch of 60,000. So total fixed cost is 150. Out of that, 60,000 is specific to that. So if this branch is closed down, the 60,000 also will not be incurred. Fine. The rest of it all will be incurred, as well as 40,000 of centrally allocated costs. All other fixed costs will be saved if the branch is closed down. So what we will do is, what is the present scenario? What would be the impact after it is shut down? So present shutdown situation. We have revenue, then variable cost, so contribution is 0. After that, less fixed cost. This is minus 150. So there is a net loss of okay. What if they shut down? Revenue will be 0, variable cost also will be 0, contribution will be 0. So out of the fixed cost, it says that a portion of the fixed cost will be eliminated. See, variable cost include 50,000 for variable cost include 50,000 for labor. Out of labor, to get rid of the labor, it is not completely variable. So to get rid of the labor, they have to spend 20,000. So minus 20 is the cost. Then the fixed cost, out of the fixed cost, it says that 60,000 total fixed cost is 150,000. Out of 150,000, it says that fixed costs contain a fixed rent charge that is specific to the branch of 60,000 as well as 40,000 of centrally allocated costs. All other fixed costs will be saved if the branch is closed down. All other fixed costs will be saved if the branch is closed down. So um, 40, 40 only will be incurred. The 60 anyway is specific to that branch. So if the branch is shut down, 60 also will be eliminated. Then if 60 is eliminated, 90 is remaining. Out of 90, 40 is allocated cost. Allocated cost cannot be done anything with that. The rest of it all can be saved. So how much is incurred is minus 40. So now the loss is minus 60,000. What will be the net benefit for the branch for the year of shutting the branch? See, without shutting the branch, the loss was to the extent of 150. Now the loss is brought down to 60. So how much are they benefited? The net benefit by shutting down the branch is the difference between these two. This is equal to, earlier the loss was 150. Now the loss is only 60. So they were able to save 90. Okay, the next topic what we have is break-even analysis. So let's take it up, break-even analysis. So the next concept is about break-even analysis. Break-even analysis, um, the whole concept, did you do cost accounting anytime in your college? Did you do cost accounting? Okay. So you understand the concept of marginal costing? Did you do marginal costing in your cost accounting paper? Marginal costing. Cost volume profit analysis break even point. Yes or no, according to BA2 as well. So you understand what are the what is the logic about it. See the concept is differentiating the total cost into variable cost and fixed cost. So we see that sales minus the total cost, otherwise sales minus the total cost is profit according to the absorption costing, the total costing. Sales minus total cost is profit, but then marginal costing suggests that instead of taking the total cost, out of which fixed cost is fixed in nature and that doesn't get affected because of a change in decision. Therefore, do not consider the fixed cost for decision making, but rather split this and then consider only the variable cost. So, sales minus variable cost is one type of profit that is called as, because variable cost is a controllable cost. So, this is controllable profit. So, that term is called as contribution. Then the contribution will take care of absorbing the fixed cost, minus fixed cost is the profit. So then we see that there is a concept about considering this contribution for decision making. So what is the percentage of contribution on sales is the logic. That is, if sales is 100%, contribution is what percentage? So contribution into 100 by sales. So that is how we calculate what is contribution margin ratio. Then a concept of what is break even point, a point where there is no profit, no loss. So that is a situation when the profit is zero. We have fixed cost coming to the other side. Contribution and fixed costs are equal. So at the break even point, both of them are equal. So we basically equate the fixed cost and contribution in both of them. That is, if it is break-even point in a number of units, we are taking fixed cost divided by contribution per unit. If it is in sales revenue, fixed cost divided by contribution margin ratio. Contribution margin ratio, contribution to sales ratio is, sales is 100%, contribution is what percentage. Then any other output other than break-even point, there is either a profit or a loss. So there is a loss or a profit situation at any other different, any other level of sales. So the ratio would be the same, the formula would be the same, but the only thing is plus we have a profit margin, that is target profit. Here, in case if we are trying to find out what is the um, any other sales level, targeted sales level, so fixed cost plus profit divided by contribution to sales ratio. Margin of safety is once they cross the break even point, there is profit. So margin of safety is equal to budgeted sales over and above the break even sales. So the difference between these two is called as margin of safety. Margin of safety percentage is, if budgeted sales is 100%, margin of safety is what percentage. So that's the logic. Since you have already learned, I am not in detail explaining how we got the equation. Okay, we'll just go through that. Then if there are more than one products produced in their product line, in that case, how do they calculate what is break-even point is? The denominator, which is contribution margin per unit or contribution margin ratio, will become weighted average, because there are more than one product. So multiple products are produced and sold. So the denominator will become weighted average contribution margin per unit of or sales. Then the graph, how it is presented. Let's quickly get back to the examination kit and then work out few questions. The break-even sales, a company has budgeted break-even sales of 800,000 and fixed cost of 320,000 for the next period. What is the sales revenue needed? What is the sales revenue needed to achieve a profit of 50,000 in the period? So let's quickly write this one. What happened? The strength is very less today. The H2. We want what is targeted sales. That is what is the sales revenue. So targeted sales, target sales is equal to, the formula is, we have fixed cost plus profit divided by contribution margin ratio. But then three variables are there. We do not know what is the third variable, which is contribution margin ratio. We know break-even sales, then we know fixed cost. So profit margin is there, but contribution margin is not there. So using the break-even sales formula, break-even sales is equal to, we have fixed cost divided by contribution. So contribution to sales ratio is equal to fixed cost is 320,000 divided by the break even sales, which is 800,000. So that's 40%. So once we know what is that, fixed cost is there, profit is there, contribution margin ratio is there, substitute. Target sales is equal to 320,000 plus the profit is 50,000 divided by, this is 40%. Check that. So 925,000. Question number 189. FPG company sells three products, FP and G. The ratio of their total sales value is 6F is to 5P is to 4G. The contribution to sales ratios of the products are given. Then, if fixed cost for the period are expected to be 160,000, the revenue to the nearest 1,000 needed to earn a marginal costing profit of 40,000 is. So target sales is equal to fixed cost plus profit divided by. But here it is not just one product, there are three products. So this will become weighted average contribution to sales ratio. How to calculate what is weighted average contribution? See, there are three products. So I'll write it here in the next line. So each of these products have the uh, contribution ratios, that is 35%, 20%, and 30%. Each of them have to be multiplied into its respective weight. Weights are 4F, 5P, 4G. So 4 is to 5 is to 6. So let's write this one. The first one we have it as 35% into 6 plus 20% into 5 plus 30% into 4 divided by the total of all the weights. Weights are 6 plus 5 plus 4. I don't know, there was a call and then I got distracted. Just look into that and tell me, did I make a mistake? 35% into 6, 20% into 5, 30% into 4. Okay, so this is weighted average. The rest of it can be done, which is target sales is equal to 160,000. Then we have the profit margin as 40,000. The entire thing divided by 28.67%. So round it off to the nearest thousand. So 697, 698,000. So or make it as so 698. Then after 189. Then we have 190. So 190 says our company provides a single service to its customers. An analysis of its budget for the year ending 31st December 20x5 shows that in period 3, when the budget activity was 6,570 service units with a sales value of 72 each, the margin of safety was 21.015%. The budgeted contribution to sales ratio to the service is 35%. Budgeted fixed cost in period 3 were nearest to 2. So we have to find out what is fixed cost. What details do we have? So we see the budgeted activity is given as 6,570 units. Selling price is given 72. In fact, actually it would be question number 190. We need to find out what is fixed cost. The details what we have. We have budgeted activity. The number of units are given as 6,500 units. 6,570 units. After that, selling price is given. Selling price per unit is equal to 72. Then after that, we have margin of safety percentage. Margin of safety percentage is equal to 21.015%. Then contribution to sales ratio is equal to right C by S ratio. C by S ratio is equal to, that's given as 35%. The margin of safety is equal, percentage is given. The formula for margin of safety, this can be elaborated as is equal to, in the numerator we have margin of safety divided by budgeted activity, budgeted units the whole thing into 100. So that's the formula. We only all what we know is only the budgeted units. What is margin of safety? Margin of safety is equal to budgeted units minus break-even units. Okay, so if we elaborate on that, see margin of safety. Okay, but what is margin of safety? If we have to elaborate on that, margin of the numerator part of it I'm talking about. So budgeted units minus break-even units, the whole thing divided by budgeted units. This is given to us as 21.015% is equal to this equation. So budgeted units are there. We do not know what is break-even units. So budgeted units are 6,570 units. Um, Solve for what is break-even units. So 21.015 percentage into the budgeted units are 6,570 is equal to in bracket 6,570 units minus break-even units. You're not able to see the screen. Now, okay. But past how long are you not able to see? Were you able to see this one, 189, when it was done? Okay. So only now it is not done. So first let's find out here is equal to 6570 into 21.015% is equal to break-even units is equal to 6,570 minus this goes 1381. So the break-even units are 5,189. Break-even units is equal to fixed cost by contribution margin per unit. Selling price per unit is given. Break-even sales is equal to the number of units of break even, which is equal to 5189 into 72 is the selling price. So that will be, we got break even sales. So break even sales, if we know, break even sales is equal to fixed cost by contribution margin ratio. So right, break even sales is equal to fixed cost divided by C by S ratio. Fixed cost is equal to break even sales is equal to 373630 into 35%. Then the closest is 131,000. The closest, if we are rounding it off to the nearest 1,000, it would become 131,000. That's question number 190. Question number 192. Our company currently sells products S, T, and U in equal quantities and at the same selling price per unit. The contribution to sales ratio for product S is 60%, T is 45%, and total is 52%. If fixed costs are unaffected by mix and are currently 25% of the sales, the effect of changing the product mix to S 45%, T 20%, U 35%. Is that the total contribution by sales ratio changes to how much? What is changed? Contribution to sales ratio is changed. Um, at present, S has 60, product T has 45, and total is 52%. The fixed costs are unaffected by mix and are currently 25% of sales. Um, okay. Question number 192. See, we don't have even one single figure also. All with percentages only we have to manage here. The details what are given is there are three different products. We have these three products. Important thing is they are in equal quantities. So one third, one third, one third. The quantities would be, so the weights would be one third, one third, one third. So that's the important point. Later on they have made a change, so now out of this S, T, and U are in the equal quantities. Then the contribution to sales ratio for product S is given as 60%, T is given as 45%, the total is given as 52, but we do not have what is the contribution to sales ratio for U. So that we need to find out. That is one point. U is not given, we need to find out. After that, if fixed costs are unaffected by mix and are currently 25% of sales. So the effect of change in the product mix. Um, See, we have the total contribution to sales. So that is nothing but weighted average contribution to sales ratio. Contribution to sales ratio is given, which is equal to. We have to consider all three of them in their respective weights. The first one is has a weight of 60%. C by S ratio of 60% and weight is 1 by 3 because equal quantities, isn't it? Then plus for the second one we have it as 45% into 1 by 3 plus we do not know what is the ratio for U, so let's put it as U into 1 by 3 divided by the entire thing divided by 1. So that is the weights have to be added 1 by 3 plus 1 by 3 plus 1 by 3. That's the proportion. So equally it will be 1. If this is taken is equal to, the answer is 52%. So we need to now find out what is the value of U. U has to be calculated. So that is what we need to do. We need to calculate what is the value of U. So this becomes 20%, 50, 35%. So 35% plus U by 3 is equal to 52%. U by 3 is equal to 52% minus 35%. So is equal to 52% minus 35%. U will be 17% into 3. So U we got it as 51%. The question says if fixed costs are unaffected by mix at currently 25% of sales, the effect of changing the product mix to the product mix is changed to 45%, 20%, and 35%. So earlier it was 1 by 3, 1 by 3, 1 by 3. So we can find out what is the weighted average. So weighted average contribution to sales ratio after the change in mix. Um, the best way is we can put it in a tabular form. It becomes easy. We have S, then T, then we have U. The C by S is unaffected. C by S ratio. Earlier, these two were given, which is 60%. Then we have 45%. Now we know even U has 51%. The weights are given. 45%, 20%, 35%. Just find out weighted average. So 53.85. So weighted average contribution margin. So that's 53.85. Okay. I heard just now that you don't want to have a class on Friday. What's the matter? No one responds. So I don't know whether you're listening to me or not. Then respond, no? I asked you something that you don't want to have a class on Friday. When do you want to have a class? Okay, fine. When do you want to have this class? Sunday. What time? What time? Just tell me what time. Same afternoon slot. 3 o'clock. All of you agree? Then 3 to 5. Okay, fine. 3 to 5 is also fine. Saturday don't want. Saturday is also fine. Because I am free on Saturday also. Of course, Sunday also I am free as of now, but I do not know. Fine, we'll get back to you tomorrow also. Anyway, you're coming, no? So I'll find out and then I know for the first time. And then Manjushri very promptly responded. That is one more thing. That was good to and see someone, and then she very promptly said, "We are listening." That also made me happy. Uh, okay, the question number 193 on the screen. We see EFG company manufactures three products which have the following cost and demand data. So E, F, and G contribution to sales ratio is given. Maximum sales value, minimum sales value. Fixed costs are given. The lowest break-even sales value per period, subject to meeting the minimum sales value constraint, is nearest to. Fixed costs are given. Then we have the fixed cost, break even sales value per period. So break even sales is equal to 850,000 divided by weighted average contribution margin ratio. So if that is what is calculated, after that we can lowest break even sales value per period subject to meeting the minimum sales value constraint. What do we do? Break even sales. Yes, break even sales. But break even sales, okay. Um, Here, the lowest break-even sales value per period subject to meeting the minimum sales value constraint. Break-even point is a point where there is no profit, no loss. So fixed cost is 850,000. At that level, the total contribution which is earned by all three products also would be equal to 850,000. There are certain limitations which are given. That is, what it could be the maximum sales value, what could be the minimum sales value. Considering that, we have to take a decision now. Now, if the total contribution which would be generated is 850,000, so let's write at break even point, fixed cost is equal to contribution. So that is equal to 850,000. So 850,000 is the minimum contribution which has to be earned. There are two things which are given. One is maximum sales, they cannot go beyond that, and then there is a minimum sales thing also which has to be satisfied, subject to meeting the minimum sales value. So now, how would this 850,000 contribution be earned? If 850,000 contribution has to be earned, then we check about contribution by each product, what is the contribution percentage and the minimum sales value. Let's work it out. If the sales is 400 into 30%, which will be Then for the next one, it is again 400 into 20%. Then the last one also 400 into 25%. So if these are the cases, we see that when we add them up, the sum total is coming only to 300. But totally only when contribution is to the extent of 850,000 that they would break even. But here the minimum contribution time is 536. Okay. So minimum contribution is equal to, we see that it is 300, but they still have to earn 550. So considering the minimum constraint part of it, which is satisfied here, um, this anyway has to be satisfied. The rest of it has to be earned by other products, these products only. So some more contribution will be contributed by the other products. So there are totally three products, E, F, and G. So when the three products are there, first part of it is the satisfying of the situation, the minimum constraint part of it is taken care of it. So how much more contribution, additional contribution to be earned is equal to total 850 they have to earn, but then from 850 already 300 is contributed from minimum sales. So that will give us 550. So 550 has to be earned by product E, product F, and product G. So the one which is more profitable will be given first preference. Most profitable is product E. So I'll end it here. We'll continue. It is already okay. For the moment I'll end it here. Tomorrow on the same note, I'll save it also. On the same note, we'll start it and then we'll take it up. Tomorrow anyway you're coming. Um, Tomorrow, day after tomorrow also you would be coming. Only the Friday thing we can either schedule it for Saturday or Sunday. Okay. Um, let's end the class here. Good day.